This AI-generated podcast is for general information only and does not constitute financial or legal advice.
You should independently verify all information and consult a qualified professional.
Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris.
Please note that this episode is current as of 15 July 2026.
Today, we are examining the operational parameters of post-trade transparency for Luxembourg banks. Specifically, we're looking at the legal mechanisms that govern private bilateral derivatives trades.
Right, and to be precise, we are examining Regulation EU number 600-2014, which we will refer to as MiFIR of 2014 throughout this briefing.
And the central thesis we are discussing today is that compliance with these post-trade transparency rules requires a very strict three-step sequencing.
Yes, that is the must-know takeaway for the audience. Firms cannot simply execute a trade and report it later. They have to assess deferral eligibility, determine the exact allocation of publication responsibility, and complete precise notifications with the regulator.
So let us examine that first step. The baseline requirement under MiFIR of 2014 is that trading in-scope derivatives outside a trading venue requires immediate public disclosure.
Correct. Under Article 21 of MiFIR of 2014, investment firms must make public the volume, the price, and the time of the transaction. The policy goal here is to mitigate risk by ensuring the broader market has visibility into these off-venue trades.
Right, it establishes objective pricing data. But there is a recognized operational challenge if a bank executes a particularly large trade.
Well, yes. Regulators understand that immediate publication of large trades could create liquidity risks. If a bank provides liquidity to a client by taking on a large position and the market immediately sees that data, other participants might adjust their pricing before the bank has time to hedge its exposure.
Which introduces the concept of a deferral.
Exactly. A deferral is a legal mechanism to postpone the publication of the trade details. It is authorized under Article 54-3 of MiFIR of 2014.
And this ties into the retained technical standards, specifically RTS2.
It does, and the Luxembourg regulator, the CSSF, provides specific parameters for this in their Q&A documentation. Basically, subject to the regulator's interpretation, there are three primary conditions where a deferral could apply.
Let us walk through those three conditions.
First, if the transaction is large in scale compared to the normal market size for that asset.
Yeah.
Second, if the derivative belongs to a class that does not have a liquid market. Or third, if the trade exceeds a size-specific threshold where immediate disclosure would expose the liquidity provider to undue risk.
So determining the deferral eligibility is the first takeaway. The trading desk must calculate those thresholds to know legally when they are required to publish.
Right. They established a timeline. But that brings us to the second core step in our central thesis, allocating the actual responsibility of publishing.
Because knowing when to publish does not solve the operational question of who actually submits the data. In a bilateral trade outside a venue, there are two parties.
And Article 21A of MiFIR of 2014 provides a very specific hierarchy to determine which party assumes that reporting duty.
And they have to report it through a secure channel, correct?
Yes, through an APA, which stands for an approved publication arrangement. Now, to determine who uses the APA, Article 21A of MiFIR of 2014 relies on a status called a designated publishing entity.
So how does that hierarchy function in practice?
It works through a symmetrical and asymmetrical test. If only one party to the transaction holds the designated publishing entity status, then that party takes the obligation to publish.
That is the asymmetrical scenario. The firm with the status handles the reporting.
Exactly. But if the situation is symmetrical, meaning both parties are designated publishing entities, or neither party is, then the default rule applies.
And the default rule is that the seller must publish the transaction.
Correct. Under Article 21A of MiFIR of 2014, the seller takes the responsibility in a symmetrical scenario.
I think it is important to clarify a frequent point of confusion here regarding a separate regulatory classification.
You are referring to the systematic internalizer status.
Yes.
That is a critical distinction. Systematic internalizer status is governed by Directive 2014-65-EU, which we will refer to as the Directive of 2014.
And broadly speaking, a systematic internalizer is an investment firm that frequently and systematically deals on its own account when executing client orders outside a trading venue.
Right. They are internalizing the order flow. But the legal analysis emphasizes that holding systematic internalizer status under the Directive of 2014 does not replace the publication allocation test we just discussed.
So just because a bank acts as a systematic internalizer, it does not automatically mean they are the designated publishing entity for a given trade.
Precisely. They are distinct regulatory concepts. The allocation under Article 21A of MiFIR of 2014 must be assessed on its own merits for every transaction, regardless of the firm's systematic internalizer designation.
Which reinforces our central thesis. A firm must sequence these compliance checks meticulously. They determine the deferral, they allocate the publication duty, and then they arrive at the third core takeaway, navigating the specific CSSF formalities.
And this third step requires strict data governance. The CSSF utilizes dedicated email protocols for these notifications, and the distinction between them is highly specific.
Let us outline the exact addresses required, because an administrative error here could lead to non-compliance.
Well, if a Luxembourg firm intends to utilize the outside venue derivative deferral we discussed in the first step, they must notify the CSSF by emailing a specific address. That address is mifid2@cssf.lu.
That is with two M's at the beginning, MIFID2.
Right. However, if an entity intends to formally opt in as a systematic internalizer under the directive of 2014, they must submit a dedicated form to a different address. That address is mifid2@css.lu.
Just a single M.
Correct. And if they are requesting the designated publishing entity status to manage reporting obligations, they also use that single M address.
It is a standard operational parameter, but it highlights how exacting the regulatory environment is.
And at this stage, it is crucial to note that simply sending the email does not grant the legal status.
I see.
According to the CSSF Q&A, specifically questions 4.2.1 and 4.2.2, these statuses are not automatic. The designated publishing entity status, for example, must be formally granted by the regulator upon request.
So a firm cannot begin trading under the assumption that they hold the status just because they submitted the paperwork. They must wait for formal authorization.
Yes. Operating before that authorization is granted would mean operating outside the protections of the framework.
So, to summarize the central thesis of our briefing today, institutional compliance with post-trade transparency relies on a rigid three-step sequence. First, assessing the deferral under Article 54-3 of MiFIR of 2014. Second, determining the reporting hierarchy under Article 21A of MiFIR of 2014. And third, executing the precise CSSF email notifications required to formalize those positions.
It is a highly structured process designed to balance market transparency with liquidity protection.
Thank you for tuning in.
We invite you to support the work by subscribing on Spotify, Apple Podcasts, or wherever you get your podcasts, and on the Bertrand Mariaux YouTube channel.
You can follow and connect with Bertrand Mariaux on LinkedIn to share comments and likes.
Please visit bertrandmariaux.com to read the full written analysis.
And remember, you can also listen to the French edition Luxembourg Fundcast.
This was the Luxembourg Fundcast.